Selling a business is a major financial milestone, but it can also trigger significant tax consequences if not planned properly. Understanding how a business sale is taxed can help you structure the deal efficiently, minimize liabilities, and keep more of your hard-earned profits. Whether you're selling a small business, partnership interest, or corporation, here's what you need to know in 2025. The structure of your sale has the biggest impact on taxes. In an asset sale, individual business assets are sold separately. Each asset is taxed differently. Equipment and furniture may be subject to depreciation recapture, taxed as ordinary income. Inventory is taxed at ordinary income rates. Goodwill and intangible assets often qualify for capital gains treatment. Asset sales are, more common for small businesses and are usually preferred by buyers. In a stock sale, the buyer actually purchases your shares or ownership interest. Most of the proceeds are taxed as long-term capital gains, which are generally taxed at lower rates. Sellers often, prefer this structure because it really simplifies reporting and lowers tax exposure. If you sell your business for more than your basis, which means your original investment plus any improvements, the profit is subject to capital gains tax. Short-term gains, meaning those held 1 year or less, are taxed as ordinary income. Long-term gains, held for more than 1 year, are taxed at preferential rates, typically 0, 15, or 20%, depending on your income. With proper planning, you can really reduce your exposure to capital gains taxes. It's definitely worth considering your options ahead of time. If you have previously claimed depreciation on equipment, buildings, or vehicles, then, part of your sale proceeds might actually be subject to depreciation recapture. This recaptured amount is taxed at ordinary income tax rates, which honestly can be higher than capital gains rates. Depreciation recapture is a pretty common surprise for business owners, and it's something you really should address before listing your business for sale. The IRS requires buyers and sellers to agree on how the sale price is allocated among assets. This allocation directly affects how much tax is owed in each category. Poor allocation can increase your tax bill, so negotiating asset allocation during the deal phase is critical. If you don't receive full payment upfront, you may qualify for an installment sale. This allows you to spread capital gains over multiple years, lower your annual taxable income, and, improve cash flow and tax efficiency. However, interest income from installments is taxable. In addition to federal taxes, you may owe state income taxes depending on where your business operates. Some states treat business sales differently, making multi-state tax planning especially important. To reduce taxes, here are a few things to keep in mind. Clean up financial records early, review your entity structure, consider timing the sale in a lower income year, and, explore retirement contributions and charitable strategies. Early planning often leads to significant tax savings. Selling your business without understanding the tax impact can cost you thousands or even millions in unnecessary taxes. The right strategy can help preserve your wealth and maximize the value of your exit. At SK Tax Associates, we help business owners plan, structure, and execute business sales with tax efficiency in mind. Contact SK Tax Associates today to plan a smart and tax-efficient business exit.